Hi, I'm Grant Stephen.
And I'm Chris Bernier.
And we're the two investment guys. This week, Chris and I want to talk a little bit about a broader market strategy, but first, if we look at the indices, we're about a third of the way through the year already, and we got Toronto is flat so far this year. The Dow is up about 14%, however. We look to Europe, we've got London up 10, and France and Germany are both up about 7%. And over in Hong Kong, they're up about 1% so far this year. And the global market leader is Tokyo, up about 36% so far. Now, so mixed results, but as I said, Chris and I wanted to talk about a broader strategy here, and we should kick it off with what we see in the U.S. earnings picture.
Sure, well, that's been the topic of discussion lately with the S&P 500 and the Dow trading at or near all-time highs. If we look at first quarter earnings for the S&P 500, we're just about all the way through, and about 71% of companies have beat analyst earnings per share estimate. That's the profit per share number. But we've only seen about 43% of companies grow their revenues on the top line, and that's the concern, I guess, when we look at the market. But if we're looking at indices trading at an all-time high here, Grant, and somebody's got cash sitting on the sidelines, what should they be looking at?
Okay, so this is always a challenge, right? Because you feel like the market's run away on you here. So Chris and I talk a little bit about a strategy where you're tranching some of your capital into the market over a period of time. You might allocate a third of your capital here and try to ignore this so-called market at all-time highs, because in prior shows we had a debate about that, and maybe they're not other than indice levels. So you take some of your money and you put in a little bit here, and then you get patient and you may buy on a dip, but you have to be extremely disciplined with this, Chris, because what will happen is if it goes down a little bit and you feel negative because you're caught in the negative news of the day, then you'll go, well, I'm just going to wait, and then they may move up again. So you have to stick to that plan of tranching it in a third and say set yourself up every 30 or 60 days or whatever's appropriate for you to do, but you just have to stay to that.
That's right, and that's what we would call dollar cost averaging approach. Try to average that money in over time. It's particularly important for people who are looking for income, because you're not going to get any income if you're not invested. So as soon as that money gets invested, you're starting to generate that income and average that money in over time. I want to thank you again for your questions and comments. Please keep them coming. You can contact Grant and I at twoinvestmentguys.com.
Join us next time. Chris and I are going to continue our discussion around the markets and share some other strategies with you. So until then, I'm Grant.
And I'm Chris.
And we're the two investment guys.